Hello everyone. In an attempt to keep things civil, I have 7 simple rules for myself. Welcome to the Angle of Reason.
What happens is the Republicans deregulate Wall Street and cut taxes for the rich with Democratic help. That's what happened. They deregulate, cut taxes for the rich.
So I've been reading and hearing about how the Trump tax plans have basically just been a tax break for the super rich. My BS meter is going off pretty darn hard at the moment. But surely no credible sources are spewing this nonsense.
Let's have tax reform that's sensible. The Trump tax plan is a tax cut for the wealthy. It's been demonstrated by multiple groups that this benefits not only the 1%, the one of 1%.
I guess I did say credible, didn't I? Well, you could apply that to Fox or the Democrat. It doesn't matter to me.
Why does a billionaire family get a $52 billion tax break? Please tell the American people.
And again, we're talking credible sources, which I don't consider Bernie Sanders to be credible either. But to be fair, in his defense, this was back in May of 2017, and they were talking specifically about the estate tax.
Between $1.5 and $2 trillion being taken from the U.S. government, U.S. taxpayers, and given to corporations and the wealthiest Americans. So, mission accomplished.
Because you can point out where all the benefits are going, and it doesn't go to the average person in America.
Just one tax cut for the rich isn't necessarily enough.
Of course, I'm not a connoisseur or target audience for TYT. I've never found them to be credible. This is no exception. So TYT being basically Cenk's network, he should be responsible for ensuring accuracy and honesty in his reporting.
Republicans are using the occasion to roll out even more tax cuts for the rich.
But of course, video overlay management aside, he is still just regurgitating what he's reading from Salon. So it seems as if there's 3 possible categories that these people will fall into. And I don't know who falls into what category. I can't read their mind. I don't know what their intentions are. But it does seem as if there's one category of people who just don't understand math. The second group are those of nefarious purposes who understand math and purposefully mislead people. The third group are those useful idiots that either see or hear one of the other 2 groups. This is, of course, the angle of reason, so I prefer everybody have the math skills to be able to understand this. So first we're going to talk about ratios. Ratios are comparisons between 2 numbers. Those ratios could be things like screen size ratios, 4:3 televisions being the old ones, and a 16:9 being a newer one. There are some interesting things you could do with screen size ratios. For example, if you know the maximum width for the area you're going to put your television, you can calculate how tall the television is going to be. You could also calculate the diagonal screen size for the televisions. I would like to also point out that there is a big inequality here between the width and the height. Why should the width get 16 but the height only get 9? See, at this point, ratios don't really mean much other than just a description of reality. So let's start simplistically talking about taxes. So we're going to start simply by introducing 2 people, John and Jack, and they pay respectively $2,000 and $1,000 into taxes. That's a 2-to-1 ratio. Now this ratio does define reality, however it doesn't indicate anything at all about inequality between the 2. It is important to note that ratios are really just comparisons between either 2 parts or 2 wholes that are at least loosely connected to each other. Next up are percentages, which are a very specific kind of ratio, which is a part compared to a whole. So now we're going to return to John and Jack, and remember they paid $2,000 and $1,000 in taxes. And now let's also say, for the sake of argument, that total tax revenue was $10,000. Following the equation, we divide by $10,000, and we end up with 2/10 or 20%, and 1/10, which is 10%. And here's where the shit really starts to hit the fan. You can change the part or the whole as you see fit to compare whatever it is that you want. In this particular case, we want to compare how much more John pays than Jack, and there's several ways that you can do it. For example, if we were to take Jack's tax liability and make it the whole, we could find out that John pays 200% of what Jack pays. Alternatively, if we wanted to use just how much more John paid than Jack, and continue using Jack as the whole, we could find out that John paid 100% more than Jack. Of course, both of these percentages are completely accurate to describe the situation that they're supposed to describe. So the real question that everybody needs to ask when someone brings up a percentage is you're comparing what with what? Math is one of those subjects that people's understanding of it can be quite hit or miss. Even if it is a hit, you can still be quite easily misled because all you're really given oftentimes is just a percent, a single number. So we're going to go back to taxes, but we're going to ditch the simplistic version of taxes and actually start using the 2017 and 2018 tax brackets. It's important to use both of those so that you can compare what it was with what it is now to see how it's changed. And in case you weren't paying attention, I did just say that we will compare what it is with what it was. So because it is insert current year here, we're going to introduce two women, Jane, an engineer, and Anita, a receptionist, who earns $100,000 a year versus $30,000 a year, respectively. So I'm going to start off with a flat tax rate, just so I could show how changes to a tax rate affect an actual dollar amount versus a percentage amount. So we're going to start off with a 20% tax rate, which is $20,000 and $6,000 respectively. Then we'll change the tax rate to 10%, which is a $10,000 and $3,000 tax liability respectively. Of course, this means that Jane received a $10,000 decrease in taxes where Anita only had a $3,000 decrease. Of course, the proponents of this tax change would say, well, it's fair because everybody got the same discount on their tax rate. However, opponents of this tax change would say, well, Jane got a $10,000 discount where Anita got only $3,000. That's almost 3/4 of the tax decreases went to Jane and only a quarter went to Anita. That can't possibly be fair. But now we get into semantics into what the definition of fair is. So we're going to switch over to the 2017 tax code, which had a standard deduction and a personal deduction, which totaled $10,400. That gets taken off of your gross income to come up with a taxable income. What's being written out here is the tax brackets. We have a 10, a 15, and a 25% tax bracket. And how this works is you subtract your standard and personal deduction and you find out which tax bracket the amount left actually falls into. And you take the max amount of tax from the bracket above it and then add the percentage of what's left inside your tax bracket. Depending on your level of skill in math, accounting, and finance, this is either going to be a big pain in the ass or it's going to be completely simple. Regardless, we have our government to thank for our tax system. I would also like to add that there are more tax brackets for 2017. However, these are the only 3 that are needed for this example. So we're going to start off with Jane. She's in the 25% tax bracket. So you take the $37,950 from the top end of the previous bracket and subtract it from her taxable income. You're left with $51,650. Because the top amount of tax for the previous bracket is $5,226.25, we then take 25% of the $51,650, which is $12,912.50 for a total of $18,138.75. So we do Anita's taxes the same way we did Jane, except she's in the 15% tax bracket. So what we do is we take the $9,325 from the top end of the previous bracket and subtract it from her taxable income. Then we take 15% of the difference and then add the max tax amount from the previous bracket with whatever the 15% of what's left in her bracket is, for a total of $2,473.75. After the deductions and the tiered tax brackets, you can see that they're not just paying 15% or 25% of their gross income. So we can come up with another percentage that's referred to as the effective tax rate. That effective tax rate is how much in taxes they paid compared to their gross income. As you can see, the effective tax rate is usually quite a bit lower than the actual tax rate for the top bracket that they're in. So we're going to move on to the 2018 taxes. The main difference here at the very beginning is that the standard deduction and personal deduction have been combined. Instead of being $10,400 is now an even $12,000. Another important change is now there's fewer tax brackets. However, it doesn't affect our little example here. Here's the tax brackets that we'll be using for this example. So we do 2018 the same way as 2017. We take the top end for the previous tax bracket and subtract it from the taxable income. Then we take either 24 or 12% of the remaining and add it to the maximum tax for the previous bracket, and we come up with their total tax liability. You can also see that Jane and Anita's effective tax rate has gone down. So let's talk about differences, both the dollar amount and the percent difference between 2017 and 2018. The dollar difference is a simple subtraction between 2017's tax liability and 2018's tax liability. The percent difference is that dollar difference divided by the 2017 tax liability to get a percent change from 2017 to 2018. You can see the dollar difference between Jane and Anita is quite large, but then again, the percent difference is large in the opposite direction. And so again, we come back to the question of what is fair? Is fair looking at the dollar amount or the percent difference? Because if you look at the dollar difference, Jane saved more taxes in 2018 than Anita ever paid in 2017. On top of the fact that Jane still paid 7.5 times more taxes in 2018 than Anita, despite the fact that she only earned a little over 3 times the income. So I took the tax brackets for 2017 and 2018 and put it on a spreadsheet at various income levels. And you can see the effective tax rates, the dollar difference and percent difference, just like we had calculated for Jane and Anita. So the tax brackets are color-coded in the tax liability columns. For example, in the $12,000 income level, in 2017 you paid $160, but in 2018 you paid $0. So you can see the effective tax rates slowly increase as the income goes up, which is exactly what it should do, just like the dollar difference. The percent difference stabilizes just north of the deductible changes and hovers around 20%. The percent difference falls below 20%, somewhere in the $50,000 to $60,000 mark. As you can see, the percent difference quickly falls off down into single digits, and there's even a surprise down here as we get a little bit lower. As you can see, as we approach the $350,000 mark, we actually start paying more in taxes. Now, no one can say that $350,000 to $450,000 is poor. I mean, at this income level, we're talking the top 1%. Of course, this increase is only somewhere in the $1,500 to $2,000 range when the tax liability is upwards of $120,000. You'll also notice that shortly after this little dip here, the percent difference goes back up, and even at $1.5 million, which is the top 1/10 of 1%, the percent difference is only like 5%. So on a $500,000 tax liability, they're only saving $27,000. So of course, there are more than just single taxpayers. There's also married and head of household that we can look at. Married taxpayers seem to have made out like bandits on this one. So just like single taxpayers, just north of the deductible changes is where the percent difference starts to stabilize a little bit. And here, it's a much larger percent difference. You can also see, as we scroll down here, that it drops below 20%, somewhere in the $150,000 to $160,000 mark. However, that's quite short-lived. As we get down here a little bit further, it jumps way back up and then starts falling back down to 20% and then drops even further. As we scroll down here quite a ways, it actually drops down to about 10%. One other group that we can look at is head of household, which I believe is intended for single parents. It's essentially a single person who can declare dependents. So head of household's tax looks an awful lot like the single taxes. However, it seems to be a bit more exaggerated, higher deductibles and higher percent differences even as we go further down, which I assume is probably the way we want it because these are single parents who are trying to take care of kids. We don't even drop below 20% like we did in the single taxpayers until well over $100,000, which was higher than the singles. The same oddity as before with the single taxpayers at this right at the top 1% mark, we go into a negative percent difference, which means they're starting to pay a little bit more in 2018. And again, we start going positive again as we enter the top tax bracket. So to say that this is a tax cut for the rich is quite disingenuous, with the exception of those couple instances where the taxes actually went up for that 1% mark. It's a tax cut for everybody across the board, and you could see that it's actually a much larger percentage difference in the lower end than in the upper end. Of course, calculating the tax liability is only half the story. We also have deductibles to look at. By and large, a lot of the deductibles were either removed or caps were put on them. Deductions for state and local taxes as well as property taxes were changed for 2018. They're now capped at $10,000 maximums. So when considering some of these deductions, you also have to keep in mind that although the personal deduction was removed, it was more or less rolled into the much larger standard deduction, and the standard deduction itself was more or less doubled for each tax group. The estate tax is another big talking point. No, it's not gone. However, the minimum amount before you're required to file an estate tax return has doubled from 2017 and is now sitting a little over $11 million. It should also be noted that that so-called death tax will see its death in 2024. Of course, as we know, a lot can happen between now and then. Different groups of people will use different sets of deductions, so I can't just say that deductions on a whole is what's making this a tax cut for the rich. So when you start talking about deductions and how they affect certain groups of people, you actually have to be specific as which deduction and why it would affect one group more than another. So next up I have a couple example videos of how statistics are misused and misinformation is spread. The first video is from Washington Post's so-called fact checkers.
The thing to remember about taxes is that the people who pay most of the taxes are the wealthiest Americans. Here are the figures. The top 10% of taxpayers pay 80% of individual federal taxes, and the top 20% pay almost 95%.
First off, I'd like to congratulate Washington Post for actually using accurate statistics. It is, however, misleading because, like I said earlier, you have to ask what is the part and what is the whole. In this particular case, the whole ends up being the entirety of the tax revenue that's brought in by the IRS. And the part is whatever bracket, whatever chunk of the taxpayers you want to use. In this case is the top 20% of income earners. So what's really funny is if everybody's tax rate changed exactly the same amount, these percentages would probably not change at all. The even funnier thing is if we had a completely flat tax rate, as in not progressively bracketed, these percentages probably still wouldn't change either. However, I think the reason why he's showing this is to try and indicate that most taxes are paid by the top 20% of taxpayers, which is accurate. However, I think he's also going to say that any tax change is going to positively affect the top 20% more than the bottom 80%, which is factually inaccurate. The reason I think he's doing this is because this is kind of a mathematical sleight of hand for those folks who don't realize what he's really doing.
For many Americans, particularly in the middle class, payroll taxes, taxes you pay for Social Security or Medicare, are going to be much larger than the individual income taxes you might pay. But President Trump isn't planning to deal with the payroll taxes. He wants to cut individual taxes.
So let's criticize him for something he's not doing. So Social Security, Medicare, and Medicaid are actually set to be quite insolvent in the next couple of years. So they really can't have tax cuts in those without making them insolvent just that much quicker. What I find funny about this is if he lowered payroll taxes just to help the low end, then he would be criticized when everything went insolvent that much quicker. If he had raised taxes, even if it was just on the rich, he would get criticized for raising taxes. And in this particular case, because he didn't touch it at all, he's still getting criticized for it.
Now, President Trump does say that he would like to eliminate deductions that mainly benefit the rich. But a lot of those deductions, such as the mortgage deduction, also benefit the middle class.
Right, this is something that I specifically mentioned earlier. There's a cap to how much you can deduct, as well as the standard deduction is more than doubled. But of course he doesn't mention that.
One other big problem for the president is that he has pledged to eliminate the estate tax. But the estate tax only affects estates larger than $11 million.
Right, that's what it's getting set to as a result of his tax cuts. It is a part of the tax cut bill for it to sunset in 2024, but as we all know, that can change if the House and the Senate flip.
The best way to cut taxes for middle-class Americans is to have the kind of targeted tax cuts that many politicians say have already cluttered up the tax code. Unless tax cuts are specifically targeted to the middle class, which is hard to do, the rich will end up getting the biggest share of virtually any kind of tax cut.
And at this point, he does actually make use of that prior statistic saying that the top 20% pays 95% of all taxes. Way to go. He's also making a point here that the dollar amount that the rich will get back is much larger than the dollar amount that the poor get back. But as I showed you before, that's sometimes quite opposite when you refer to a percent saved. These guys are trying to be slick with numbers on a populace that's having trouble with math.
Well, 44% of the new tax benefit for pass-through business owners, some of whom can now deduct 20% of their business-related incomes, goes to households earning $1 million or more every year. That adds up to $17.8 billion in benefits. Out of a total of $40.2 billion that goes to all groups, more than 3/4 of the benefit of that change goes to households earning $200,000 and higher.
So here we obviously have the Young Turks. First up, we have to define some terms. A pass-through business owner is essentially a sole proprietor or a partnership. Specifically, it's ones that pass all of the business income through the business owners. There are several requirements for this, specifically if the income is below $315,000 for married couples or $157,500 for singles, you can straight up deduct 20% off your taxable income before you calculate your tax liabilities. The next border above that is $415,000 for married couples and $207,500 for singles. In between those two income borders, the benefits start fading out. So if you're above that top border, your deductions are capped at either 50% of your share of the W-2 employee wages or 25% of the W-2 wages plus 2.5% of the acquisition cost of your depreciable business properties. Basically, if you're over even the low cap and you have no W-2 employees or any real property, then you lose your deduction altogether. On top of that, once you get over the lower income threshold, if you're in the service sector, say healthcare, law, accounting, consulting, athletics, investing or investment management, trading and dealing in securities, so on and so forth, then you lose your deduction altogether. So just to summarize all of that, anyone below the lower threshold gets a 20% deductible. After that, it starts to fade away and only applies to producers and manufacturers. Above that upper income threshold, it only applies to those that employ people, and the deductible is capped. Now that that's out of the way, I could deal directly with a graphic. So just like before, you have to ask yourself, what's the part and what's the whole of these percentages that they're presenting? Well, the first part that I can point out is that it does actually say $40.2 billion for all income groups and $17.8 billion for the households over $1 million. And quite literally, the $17.8 billion is 44% of 40.2. Although it doesn't give a dollar amount, it does also say that 3/4, which is 75% of that $40.2 billion goes to households earning over $200,000. So let me go back to my spreadsheet and I'll work an example to show you why some of these numbers that they come up with are really kind of pointless. So here's the spreadsheet again. I'd like to point out the dollar difference column. This is the difference between the tax liabilities for 2017 versus 2018. The dollar difference increases because as taxes are lowered in lower brackets, it affects taxes in brackets above it. I added 3 more cells to the bottom. The top one adds the dollar difference for only the 1 million or greater incomes. The second one adds all of the dollar differences for the entire column. And the last one is the percent for the whole and the part that I just described. Notice that even though the 1 million plus incomes only got 4 to 5% or so reduction in taxes, because they pay so much taxes, the sum of their dollar differences is still over 50% of the total. These are the equivalent numbers presented by Yahoo and regurgitated by the Young Turks. No one in their right minds would say that this tax structure favors the top end. The next question you should be asking is if this is for single taxpayers or married taxpayers, because the income thresholds are different. The reason I ask this is because over the lower threshold, the deduction starts getting capped to half of the wages of the employees and property. So almost all of the numbers presented here are bupkis, except for the wheezily referred to 20% reduction some business owners have while talking about the 1 million plus households, because that group doesn't have a 20% deduction.
Which actually hides a little bit of the truth.
Boy, you could say that again.
Households earning less than $100,000, which is what I would classify as actual small businesses, are expected to claim about 7% of the benefit.
Everything I said before still applies here. So let's assume that it's 20% for everybody top to bottom. What they're saying, what they're complaining about, is that 20% of $100,000, which is $20,000, is not equal to or greater than the 20% of $10 million, which is $2 million. And we can continue on with math with this. I mean, the 20% of $100,000 was $20,000. So what percentage deduction can you apply to someone at $10 million that will actually end up being a smaller reduction than that $20,000? But of course, I can tell you the answer to that. It is 0.2% of $10 million will be exactly equal to 20% of $100,000. So I guess this means they're just upset about math, I guess?
And I don't recall them saying we need to reform pass-through income so that small business owners can get 7% of what the wealthiest corporations and individuals are making.
This is a common misconception. Deductions and tax breaks doesn't mean that they're given anything. These folks earn everything and the government is just taking less of it away.
The median household income is $59,000.
Yeah, even less. I don't have the breakdown for that, unfortunately. That's the lowest increment that I can go down to.
Now, of course, they're confusing the small businesses and individuals. This wouldn't be TYT if they didn't continue on with their ignorance on math, hoping that their audience is even more ignorant than they are. Just for the fun of it, here's a graph of what the effective tax rate is like currently. The tail end levels off and approaches the tax rate for the top tax bracket. This one is what a true classical or Enlightenment era liberal would want effective tax rates to look like, simply because it applies evenly to everybody. Oddly, Ted Cruz, the conservative, proposed this during the primary elections. However, progressives, as they seem to like to call themselves, seem to really want a tax rate more like this, where you don't get taxed at all until you get above their magical income level where you shouldn't be allowed to earn any more, and then the tax rate quickly jumps to 100%. And of course, here's a libertarian's ideal tax rate. Because, taxation is theft. Am I right, guys? If you like this video and would like to see more, please comment, like, subscribe, and or share. If you don't like this video, please leave me a comment so I could do better next time. Links to Facebook, Twitter, Minds, and Patreon are in the description.